Hello, everyone. My name is Nathan Corey, alongside Dan Brown here at Richardson Capital Management, and we are here today with the Economic and Investment Update for the month of February 2026. Well, Dan, the month of February was another month with no shortage of headlines hitting the press and impacting the financial markets. On the fixed income side of the world, we saw the interest rate environment continue to moderate, which led to significantly positive returns on the fixed income side. We obviously saw increased geopolitical tensions in the Middle East, which impact the price of oil, bringing that to a 7-month high. And then, of course, we saw the Supreme Court decision on the tariff policy that had been in place. And with all that in the background, we saw very mixed returns on the equity side with stocks. We saw some sectors positive, others negative, kind of depending on size and geography. Do you want to talk a little bit about kind of what that means for investor portfolios in that context?
Yeah, so Nathan, as you alluded to, mixed returns for the month. But if we look back over the past year at the equity markets, what we've seen is that for the first time in really a long time, the large cap U.S. stocks, which are represented by the S&P 500 index, have actually lagged a lot of other indexes and benchmarks. So, for example, small cap stocks have outperformed, as have developed international and emerging market stocks. And again, it's been a long time since we can say that,
Right.
probably a multi-year period. So it just goes to show that maintaining a diversified portfolio, not just comprised of U.S. large cap stocks like the S&P 500, is beneficial for client portfolios in the long term.
And when we think in terms of that disparity between the S&P 500 or large capitalization stocks and kind of the rest of the markets, a item that hits the headlines a lot is this idea that valuations are stretched. And when we're talking about valuations, traditionally we're talking about that price to earnings ratio, or how many multiples of a company's earnings investors are willing to pay for that stock. What have we been seeing kind of on the earnings front, which is obviously a key input of that calculation, and for all of 2025, and how do we see that going forward for this year?
Yeah, so we're almost all the way through fourth quarter earnings reporting season, probably about 90%. And the results, once again, like prior quarters, are coming in very, very strong. So what we've seen probably the last 5 or 6 quarters is that companies are pretty meaningfully beating expectations, both on revenues and bottom line earnings. And it's pretty much across all 11 economic sectors. So basically, we're wrapping up fourth quarter earnings season, which means we're wrapping up the full year 2025. And what we're going to see is that earnings for the full year are coming in at about 14% earnings growth, which is historically strong, definitely above average. And as we look out to 2026, we're seeing that expectations for double-digit earnings growth are holding steady. So we're pretty confident that the earnings growth can be, 2026 can be another year of double-digit earnings growth, led higher by things like, technology, information technology, and communication services.
Got it. And Dan, if we take a step back from corporate earnings and just kind of look at the economy as a whole, the measure that a lot of folks pay attention to is that gross domestic product, or GDP. And we saw the Q4 print come in at a 1.4% annual rate, which was significantly less than expectations of 2.8. Do you want to talk a little bit about kind of why that occurred and what we're seeing for this year?
Sure. So if we look at the components of GDP, the actual makeup, the consumer continued to spend at a pretty decent pace. Business investment was solid. Housing was a little bit of a minor drag, but the big drag was really on government spending.
Mm-hmm.
And if we reflect back to what was going on in third and fourth quarter, we saw the longest government shutdown on record. So we think that was a pretty meaningful drag on spending in the quarter. And if we think about, what's in store for the future, we think we'll see a rebound in first quarter GDP to kind of make up for that negative shortfall. But again, looking at the components, we feel pretty good about the components for a pretty healthy year for 2026.
And again, Dan, one of the major news stories for the month of February was that Supreme Court decision on the tariff policy, which has been in place for almost the last year. And in that decision, they kind of struck down the current tariff policy. But the administration responded by kind of swiftly implementing a new 10% tariff rate with threats of increasing that to 15%. Obviously, there's a whole bunch of unknowns on how that's all going to play out. But if we kind of take a step back and look at that situation more broadly, you want to share a little bit about what we're seeing in terms of impact of the market and what we see going forward?
Yeah, so back to the decision itself, it really wasn't a surprise to the market. I know the Washington, D.C. policy teams that we've been paying attention to, they kind of predicted that. I think the
Hmm.
market kind of knew that the Supreme Court would strike that down. And as you alluded to, what's interesting is the same day that the Supreme Court struck that down, President Trump came out with a new set of tariffs under a different ruling.
Right.
So specifically, it was referred to as Section 122, and that allows the president to implement tariffs pretty much immediately. And he did that at a 10% tariff,
Hmm.
threatened to raise it to 15. So what it means for the overall market, the overall weighted average tariff situation. So the first graph we're looking at basically shows kind of the history of tariffs over the past year or so. And you can see most recently they were averaging out to about 14%. And with that recent ruling that we saw, the Section 122 replaces the IEEPA ruling. Basically, that tariff rate goes down to about 10.4%. So a little bit of a benefit, but don't think that tariffs are going away completely. We think this is going to be a pretty fluid situation for a while. But again, companies have navigated the situation just fine. So we're actually encouraged by that. And if we look at the next graph, it basically shows country by country, which countries are going to benefit and which countries have maybe been hurt by the pre and post Section 122 rulings. So the blue bars are the tariff rates for countries under the pre Section 122, and the beige bars are the post Section 122. So we do see there's some pretty important trade partners that will benefit from the current tariff situation. So, for example, countries like China, Vietnam, Brazil, India, which are pretty big export countries to the US, those tariff rates are going down. A couple countries that might be negatively impacted at the margin, the overall European Union, the UK, and Australia. But again, I think the main message is this is going to be a fluid situation. It's going to be with us for a while. But the bottom line is companies have navigated the situation very well. Again, we talked about earnings for 2025 being double digits, and we're expecting double digit earnings per share growth in 2026.
Yeah. So with that in mind, Dan, despite the kind of uncertainty with tariffs, we've seen companies kind of deal with that quite favorably. And I assume you feel pretty positive about the markets going forward.
Yeah, we've felt positive for a while and still feel positive even with the tariff stay with us for a while.
Well, with that, we want to thank you for watching. As always, we appreciate your continued trust and confidence, and we hope you find value in this video.